see. Okay, I think we have a quorum, so we'll go ahead and kick it off. Hello, everybody. My name is Emma Hecker, and I am the Policy Associate here at the Economic Innovation Group. Today's webinar is on financing clean energy solutions in opportunity zones. I will be co-hosting with Rachel Riley of Aces and Archers, and we are thrilled to be joined by our great guest speakers, Julia Wilkinson of Obi Power and Paul Mitchell of Energy Systems Network. So we're really excited to hear from these fantastic practitioners in the opportunity zone space and to learn a little bit more about how they're using the policy to invest in green energy and clean energy infrastructure. So a few housekeeping items before we get started. We'll be sharing a recap, including a recording and slides afterward. That will be available on our website, and everyone who has registered for the webinar will receive a link to those resources. We've also reserved some time for a Q&A session after the presentations. So as you have questions throughout the webinar, please put those in the Q&A function, as that is easier for us to track than in the chat. And we will try to answer those questions as they are received, but we'll also have some time at the end for additional questions. So as far as the agenda goes, we'll start with a few opportunity zones resources and updates before we turn to the topic at hand, which of course is clean energy, innovation, and infrastructure. We will be discussing uses of OZ financing, investment structures, models for partnerships, as well as climate and social impact. So first, I wanted to mention that EIG recently published a first of its kind exploration of Ohio's opportunity zone investments. The briefer uses administrative data from the state of Ohio to examine how Ohio's OZ projects are benefiting not only from the federal incentive, but also from the state's complementary OZ tax credit program. So in order to benefit from the state tax credit, an Ohio taxpayer must invest in an Ohio-based opportunity fund, which must then direct those funds into a qualifying project or business in any of Ohio's 320 opportunity zones. In exchange, the state provides qualifying investors with a non-refundable tax credit equal to 10% of the total funds that were invested, and that credit's worth up to $2 million. The $2 million cap is an increase over prior years, thanks to new budget legislation signed earlier this month by Governor DeWine. So a few highlights from EIG's findings. So at minimum, 22.5% of Ohio's opportunity zones have received investment, totaling at least $453 million in OZ equity over the course of the state's 2020 and 2021 budget years. And over 350 entities invested in at least 215 district developments or businesses across 72 census tracts and 18 counties throughout the state. So if you're interested in checking out the full post, I'd encourage you to go to our website or click on the link in the presentation. I also wanted to mention that the recording and recap from our previous OZ webinar, which was on engaging investors in opportunity zones deals, is now live. So if you're interested in reviewing that webinar or looking at any of those resources, they're also available on our website. Also on our website, you'll find our opportunity zone activity map, which provides an overview of some of the most impactful and innovative opportunity zone investments, funds, activities, and initiatives throughout the country. And then finally, I'd encourage you all to check out our OZ investment profiles to see what other practitioners are doing with the opportunity zones incentive. So with that, I will turn it over to Rachel Riley to introduce our guest speakers.
Yeah, thank you so much, Emma. It is wonderful to be having this discussion on how opportunity zones can help finance clean energy innovations and solutions. as well as infrastructure, much needed infrastructure, because this is something that we've been tracking since the beginning of the policy, is how can tax advantage investments be used to help further other policy goals. That's how I'll put it. And it's really exciting because we're already getting some proof points, some models that we'll talk about later on during the webinar. But with the new administration also comes potentially new resources to help accelerate these models and build out other ones. And so I kind of want to ground the conversation in that at the top, because there is this overlooming or like overarching or looming discussion around the new administration's focus on positioning American workers and industry to tackle the climate crisis. And so wanted to highlight just two things, just so folks are thinking about it. Of course, President Biden announced his 2030 greenhouse gas pollution and reduction target in April. And that's really aimed at creating good paying jobs and also securing the US leadership on clean energy technologies, and really specifically around the greenhouse gas emissions. This administration, I think, is going to be very much focused on investing in infrastructure and innovation, also fueling equitable recovery by expanding supply chains, bolstering manufacturing, creating jobs, all that lead to a more sustainable and resilient future for the nation. And so clean energy obviously has its place within that. Also, one of the goals amongst the broader 2030 initiative is just around advancing environmental justice and social justice by improving the health and financial well-being of families and communities. And so I think it'll be really easy to see how both the presenters can touch on how their projects are doing just that and their investments are doing just that. So the fourth really prong of the Biden administration's 2030 goal is to bolster domestic supply chains around American-made clean energy products and solutions. So, you know, after the announcement of the 2030 plan, there was also this, the rollout of the Made in America tax plan, which is basically the Biden administration's tax reform position. And within that, you can find under multiple different initiatives or measures, indications around creating good jobs for EVs or electrifying vehicles, investing in clean energy assets in general, spurring modernization and delivering clean electricity, jumpstarting clean energy manufacturing through federal procurement. So you're thinking about contracts for businesses that OZ equity may be invested in, and just another measure around investing $15 billion in demonstration projects for climate R&D priorities. So all of this to say that I think that there will probably be some complementary tax incentives that could help make projects pencil or work alongside OZ equity to help support these sorts of investments, whether it be in real estate or infrastructure or the actual operating business side of it, as well as additional federal spending to help achieve these goals. We already, as I mentioned, know that there are some proof points in the marketplace where the tax policy is being used to drive capital to operating businesses and energy infrastructure that are very much aligned with the administration's goals. So supporting climate solutions, advancing clean energy innovation, creating really well-paying jobs in all types of communities throughout the nation, so rural, suburban, and urban. And also we'll speak a little bit about how the first project is through partnership helping to upskill workers living in some of the nation's most distressed communities, so opportunity zones in particular. And with that, I do want to turn it over to our first guest speaker from Obi Power. I won't give away too much, but it's been great to talk with Julia over the past couple of months about what OBE is doing as far as the EV industry and how OZ Equity is helping their broader capital raise and expansion of their product outside of their original market. So Julia, I will turn it over to you.
Thank you so much, Rachel and Emma. And it's great to be here with all of you and talking about this important subject, both opportunity zones, equity, and climate action, for all of which I feel very passionate about. So just as a little background, I'm the Chief Revenue Officer of Obi Power. In that role, I manage revenue model strategy, deployment of new revenue streams, activation of stakeholders, partnership building, and ESG management. My background is in impact investing and acceleration of early stage companies, both in the US and in emerging markets. I have always been passionate about the intersection of capital markets and social good. And to that effect, I engaged with Obi Power first as an accelerator and advisor to them, an investor, and then became so passionate both about the model, the potential, and this sort of intersection that I joined the management team about a year ago. Since then, the company itself is an electric vehicle charging as a service company, founded in 2017. So not brand new to the market, but one of the early pioneers of EV charging as a service. It was founded by two Latinx serial entrepreneurs with deep ties to the renewable energy sector. And since its growth to 230 points today, it is the second largest owner and operator of charging points in the state of Florida. And we're currently expanding into Texas, into micro living communities, as well as other types of residences, workplaces, and municipalities. Same with North Carolina, Georgia, Arizona, and California. So the company offers to host properties such as, like I mentioned, municipalities or workplaces or multifamily residences, smart universal charging with the support of a live digital platform and CPO or charge point operator platform. Our software as a service digital platform is powered by the data we collect from our sessions to make informed decisions on where to install amenities, how to manage utilization of those amenities as adoption grows, and how much energy is being used, how much CO2 emissions are being saved. So it provides a lot of analytical data that helps us manage energy and track our impact over time. As you guys probably know, electric vehicles are taking off right now. And with the Biden administration support, we're seeing quite a bit of acceleration on the speed of adoption. Not only are we expected to grow to about 3% of car sales today, which are electric, to about 10% in the next 2 years. But by 2030, there'll be over 18 million electric vehicles on the road that require approximately 3 to 4 million charging stations across the nation to support their charging needs. So Obi Power, I met Obi Power at the Rise of the Rest competition, which Steve Case was hosting in Miami, Florida. And it was clear that they were committed both to the impact as well as to community building. The founders, as I mentioned, are diverse. The cap table includes many investors of color and of different ethnicities and gender. And it seemed like a well-aligned company for both impact as well as opportunity zones. So I'll explain a little bit more why OBE Power ended up as an opportunity zone, located in an opportunity zone and as an opportunity zone business. But first, just to explain a little bit more about the model, Obi Power executes long-term exclusive agreements with host properties. Some of those include like Miami-Dade County, Palm Beach County, and different multifamily units around the city. That's important because we're able to grow at each location and deploy hardware over time rather than deploying a lot of hardware at one time and competing with other companies for charging usage. This makes the model more sustainable and it makes it more committed to the long-term stakeholders in that community. Obi Power currently has over 64 hosts and municipal clients. And what's exciting about this is it's not just focused on charging, on providing charging use to drivers, EV drivers, but is also focused on the energy management aspect of EV adoption. So as you may have heard, EVs actually store a great deal of power, as well as, of course, which is needed for long distance driving. The range is, growing from up to 200 to 300, 350 miles in some cars now. And as a result, the battery storage in each vehicle actually can serve as backup storage during certain peak demand times in cities, or when there's a crisis that requires resilience. So for example, what we saw in Texas last year, the energy crisis that ensued as a result of the freezing temperatures, could have been mitigated to some degree if we had a lot of distributed electric vehicles that could be actually leveraged as a virtual power plant to discharge in moments of distress, or moments where the grid is overwhelmed during peak times of the day. And that is not science fiction. It is already being planned by a lot of manufacturers. The Ford F-150, F-150 Lightning that Biden has been, broadly promoting in his campaign, as well as, as a great American manufacturer that is now putting out one of the most iconic American vehicles with electrification. That battery can charge a home for 2 to 3 days by itself. So it's exciting that we're also positioning ourselves to be part of the bi-directional energy future, where drivers are both charging and also making money and creating energy value for smart cities, for utilities, for even behind the meter energy management at buildings. So this distributed energy allows for a greater resilience in the times of crisis that are inevitable with climate change, and also greater inclusion, because not only do utilities benefit and make money off energy production, but so do possibly properties and drivers in a sort of energy arbitrage model. So if you go to the next slide, you can see kind of how this might look. You would have charging amenities, a sort of virtual energy trading auction, where utilities see a benefit to calling energy from vehicles in the market rather than spending a lot of infrastructure investment in peak power plants. And also, again, these cars can be backup or resilience efforts in moments that there's for outages in the grid entirely. So if you can move to the next slide. Why did Obi Power turn out to be an OZ business, and why is it well aligned to be one? So when I, again, met Obi Power, they were already very purpose driven. They're founded by a diverse team. Their mission is to accelerate the transition to e-mobility to solve the largest cause of CO2 emissions in the United States, which is transportation. Accounts for 29% of emissions, while globally that depends a bit on the country. In the US, it is the #1 cause. So in that sense, they were mission aligned from a corporate structure and mission perspective. However, they're also headquartered in the Cambridge Innovation Center. And in my work prior to joining the management team at Obi Power, I was also, as I mentioned, working in impact investing, and excited about the new tool that Opportunity Zones offered investors around impact, to try to motivate more people to think about investing capital outside of the traditional buckets or in areas they were traditionally going, and benefit from the tax benefit, assuming that the mission was aligned and that it made sense for the benefit of the local community and the broader society. So in that role, Cambridge Innovation Center actually hired me to work with them to understand, since they're domiciled in a opportunity zone between Overtown and Alapata in Miami-Dade, and their goal was already really focused on bridging innovators that are socially minded, that are purpose-driven, providing them access and resources that allow them to scale in neighborhoods that are traditionally not the centers of venture, by also connecting with an anchor educational institution. In this case, it's my University of Miami's tech transfer office is also located here. They also have a wet labs and different science labs that entrepreneurs are able to use to scale their business. And they're really focused on bringing together stakeholders from different neighborhoods, from different backgrounds to try to advance impact. In fact, I've been to events that you guys, Economic Innovation Group has hosted at the CIC, and often they bring over other types of stakeholders to try to lead on meaningful impact through opportunity zones. As a result, we realized that Obi Power, which was already domiciled at the CIC in Miami and was already mission aligned, was in fact in an opportunity zone. The team and the whole team works there still. Everyone is paid in the office. Our revenue is generated there. All of our contracts as owner and operators are held there, and so is the IP of the technology platform, and all of the data science, et cetera, that we consider key to our valuation. So as a result, we realized that we might actually qualify as an opportunity zone business, and felt that given we also are focused on engaging the community on climate action, our founders have been actively involved in stakeholder engagement and education of different stakeholders, both in the community and the LMI community and in the local educational institutions like Miami-Dade College, that we were also well aligned to continue committing to developing a workforce that is trained potentially from LMI communities in opportunity zones, from hiring locally and leveraging the Cambridge Innovation Center's existing other co-working spaces in the country to expand and continue to be an OZ business in new cities as we evolve, because we are, as I mentioned, going to several new cities around the country that have high urban density. So in that moment, we decided that we could potentially speak to investors about this and see if anyone was interested in investing in Obi Power as an opportunity zone fund. And around that time, in mid 2020, we met Verte OZ Fund. We met Leonard Mills, who I'm not sure if he's on the call today, but was very much excited about the opportunity to find a early stage company committed to impact, that was founded, as I mentioned, by a diverse team, and that was also very much committed to scaling and willing to scale as an OZ business. So Verte Fund invested in Obi Power in an earlier stage round, and has helped us do a great deal in kind of positioning ourselves in the space and helping us grow. They have other companies in their portfolio that are complementary, including one that is focused on servicing municipal fleets, electric fleets in opportunity zones, and building service hubs where they can also train workforces from opportunity zones on how to fix EVs, how to service them, how to manage fleets. So that we found that also a good synergy from a partnership perspective. So basically, how we kind of fit into the OZ, as I mentioned, how we qualify as an OZ business. We passed the 50% threshold on all of our key metrics on employee hours worked, revenue made, and salaries paid, and our IP, our tangible contract assets, and our and not all of our stations, but a fair amount of our stations are also in opportunity zones. So that is sort of the journey that we've come through till today, but we're very excited to find ways to continue to leverage this legislation as we grow, and hopefully bring more evidence of exciting opportunities. They're both profitable and impact driven to the market, to show evidence of success of the legislation.
Thanks so much, Julia. I do want to underscore a few points that you made before we move on to Paul, but we've been in touch with Verte OZ Fund since, again, enactment or shortly thereafter. And I think that they are such a great example of being able to structure and move beyond the barriers to investment into operating businesses. That's something we hear all the time. There's just some barriers or hurdles to investing in operating businesses that have kept folks on the sideline. But Len and his team at Verte have figured out that model, and impact has always been sort of baked into their investment thesis, right? They wanted to invest in early stage businesses that were achieving high impact disruptions or working towards high impact solutions. And so I'm just so glad that they found you. But one thing I just wanted to confirm or clarify, as part of the Verte OZ model, my understanding is that they're doing 10-year investments. Is that true? Is that what you guys received?
Well, I mean, because of the legislation's, requirement for the 10-year full tax benefit,
Mhm.
I mean, that's the target, of course. There's always a risk in this, as we scale, that at some point we will be acquired, or, there'll be some transition that will shorten that period to under 10 years for the fund. But we're committed to the long-term value creation here, and there's no obvious reason why that would happen today. But of course, that's, one of the challenges of the legislation from a sort of business perspective, because you get pressure from different types of investors, some who see things in a much more VC way and want an exit that will, be a multiplier, and others like Verte who have a very long-term committed vision. Now that helps us as committed to the impact to make sure we're able to have investors like Verte at the table, also emphasizing the importance of long-term value creation of the stakeholders, et cetera. But those are forces that are always at play
Yeah.
in business world.
Yeah, so just it's definitely possible, and there are funds out there that are doing that and doing 10-year investments. And then the other thing that I wanted to mention, because we always talk about this as a best practice, reaching out, involving community stakeholders, engaging anchor institutions. And so the partnerships that you have or are forming to help upskill local workers, I see that as a real, something we should continue to elevate, but it's also one of these sort of like secondary benefits of OZ investments. You're benefiting the business, but based on how the business is operating within the community and engaged within the community, there's these secondary benefits that could come out of those OZ investments by way of, supporting workers that reside in opportunity zones.
Yes, absolutely. So for one, like I mentioned, being in the co-working space CIC helps because that's one of their core missions as well, bringing together stakeholders from the community, making sure they're getting in front of the startups in the CIC for job opportunities. Also working with Miami-Dade College, the largest community college in the country, that has one of the few, I think, although I'm not 100% sure, EV certification programs. It's like a Tesla. It's a Tesla funded program, and specifically for Tesla vehicles, but really, the many similarities. And now I think as the market gets more profound in all manufacturers building electric cars, it will be broader in its outlook. But yeah, we're trying to source employees from programs like that. And because this business both includes a distributed workforce, like electric contractors in different areas that are working specifically on sustainability, and salespeople that are approaching municipalities and other types of clients, we're able to also create a kind of different tiers of entry level work and different layers of work, and help people build up a career inside of a startup like this. And we hope to make more partnerships like that as well. We also are emphasized as an urban sustainability brand. We try to elevate other stakeholders. So we just started working with a nonprofit called Before It's Too Late that that activates local artists to paint murals on climate change and climate action to inspire people to go electric. So we're working on a program to paint the stations and elevate. In fact, if you go to the site before, you can see the one that we just fit, or one before, sorry. The one, it doesn't show the full wall, but we have a whole wall and floor of animals in Biscayne Bay that are endangered, whose survival depends on us mitigating climate change, and sort of emphasizing the importance of going electric to these different stakeholders, as well as making the experience more valuable and engaging to our customers. So definitely partnerships are important to us to maintain that to maximize the impact, let's say, of the company's purpose.
That's great, Julia. And I love the art installment, and just that being, the influencing or marketing that with good intentions. That's awesome.
Yeah.
Well, thank you so much. Just a reminder before we move on to Paul, if folks have questions, please feel free to use that Q&A box. We will have time for Q&A with both speakers after Paul concludes his presentation. But yeah, so here we go, Paul. Here we go, Paul. Paul Mitchell from Energy Systems Network. This was another really exciting model that we heard about recently. If folks remember, EIG did a report last fall called Delivering Opportunity in Indiana, and the team at EIG was really deep in Indiana for a while. And so we heard about this awesome initiative, which is called Hoosier Solar. Energy Systems Network is a lead partner in Hoosier Solar, which is an Indiana-based energy company. And really, my understanding, and Paul, please correct me if I'm wrong, but it's a consortium of different organizations that are going to be developing, constructing, and owning these solar assets in Indiana's opportunity zones. And like we just mentioned, there's going to be secondary benefits, like supporting local jobs, both through construction and procurement, as well as tax revenue. So I'm really excited for you to share the model that you're working on and leading in Indiana, and hopefully it sparks some inspiration.
Thanks, Rachel and Emma. Just trying to show my video. It says it's locked, so maybe that'll. Oh, there we go. Well, thank you very much. Yeah, no, I think you did a wonderful intro. Paul Mitchell, President and CEO of Energy Systems Network, and if you go to the next slide, I can kind of walk you through how Hoosier Solar came together. So Energy Systems Network, the group I've been leading for over a decade, is a Indiana-based nonprofit organization that works in the area of advanced energy and transportation, project development and execution. We get about half of our funding from the state of Indiana and philanthropies in Indiana, and the other half from industry. So most of our projects have some type of public-private benefit being combined in the energy and transportation space. When the enabling legislation that created opportunity zones passed, Governor Holcomb, who was then governor, is still our governor in Indiana, asked ESN to look into the potential of rural opportunity zones across the state as sites for energy projects. At first, we looked at it with a kind of an open mind, and it could be any type of energy project. And as our team studied it, we found that solar was really an excellent fit for a number of reasons, both from a financial modeling standpoint in terms of how investments are made in solar, how long they're held, the nature and timeline of those investments being secured and projects being built. And then also just from a geographic and logistical standpoint, where some of our rural opportunity zones were located and where there were key interconnection points, physical infrastructure like substations that are needed to tap into the wholesale market. So we knew that the idea of doing solar in rural opportunity zones had promise, but we knew that to actually execute on this strategy, we would need some partners. So we brought in a company, Innovative Solar, that's another Indiana-based company, for-profit firm that does solar EPC work, or engineering, procurement, and construction. And they had also started to dip their toe into general development of solar projects. They are a mid-sized EPC, right? They had done about 450 megawatts of solar, but we're starting to get into the bigger projects, 50, 100, 200 megawatt type of projects. And the fact they were based in Indiana was really important, because part of our mission from the beginning was how to maximize the economic development benefits that would be associated with these solar projects within the state of Indiana. And to do that, we needed to capture the value stream around the revenue that's generated by the engineering, procurement, construction work. We also knew we needed a finance partner, somebody that was both experienced with kind of state level economic development driven capital investment, but also very knowledgeable about the Opportunity Zone program, which at the time we were forming this was still in its early days. And frankly, we were getting our strategy up and going when all of us, I think collectively, we're still waiting on some of the early guidance that came from Treasury on how exactly the Opportunity Zone program would work. And Advantage Capital was the firm that we partnered with. They fit the bill perfectly. They've been working for several decades in a number of different states, I think 23 some odd states across the US, on a range of government enhanced, tax enhanced, both at the state level and the federal level, investment vehicles, things like affordable housing, Section 42 tax credits, but also we're getting into solar, and we're studying and spending a lot of time talking with accountants and other experts on the specifics of the Opportunity Zone program. So we got really up and going with the general strategy in the end of 2019, but really weren't able to fully commit until Treasury came out with some guidance that really addressed one of the real key variables for a solar investment was whether you had to actually own the land in which the investment was being made, or whether you could lease the land. And as anyone in the solar industry, renewable energy industry knows, these deals are largely done through long-term lease agreements with landowners. And so when the guidance came out that gave us the assurances that you could in fact use Opportunity Zone funds to implement traditional solar programs, we formed Hoosier Solar as a Opportunity Zone fund. So Hoosier Solar itself is a company that is a blend of the three firms that I mentioned, and our collective staff sort of work together to implement the business that is Hoosier Solar. And the funds that were raised to develop our projects, which I'll speak about their locations momentarily, were raised as Opportunity Zone funds. So they were capital gains dollars that were invested from our investors, which largely came from the investors and owners of Innovative Solar and some of the senior management of Advantage Capital. So it's a fairly small group of folks that have initially gotten this started. We know that as we scale these projects and move into the construction phase, there'll be an opportunity to bring in hundreds of millions, actually billions of dollars in capital to implement the projects, and that may be another opportunity for further OZ capital investment versus just traditional tax enhanced capital that is invested in renewable energy projects. If you go to the next slide, why Opportunity Zones in Indiana? Why was that our focus? This is a map of the 156 Opportunity Zones that were identified by Governor Holcomb. What you'll see on this map is that our governor, and I think this is probably not uncommon across the country, essentially made the decision to distribute the Opportunity Zones in sort of a fairly even geographic distribution. So, you'll see lots of zones in urban areas like Gary up in the Northwest, or Indianapolis in the center of the state, where the census tracts are, as far as this map is concerned, small. There may be several city blocks, but then you'll also see these zones that were identified in census tracts that are extremely rural, really where the entire census tract and the entire zone is really nothing but farmland. And some of these larger boxes are actually thousands of acres of land versus maybe just a few city blocks for the zones that are in the more urban areas. And so the question became, well, what is the purpose of those zones? What can actually be done in a large rural tract of land? In many cases, not even necessarily close to a key interstate highway or a major city. These are just rural counties, fairly low population. And that's what kind of sparked the concept of looking at these for solar, which in the state of Indiana is growing at a very rapid pace, similar to what you're seeing, I think, throughout the industrial Midwest. The demand among our investor-owned utilities and among corporations to acquire enter into long-term contracts for renewable energy projects, primarily solar, is really tremendous. We went from utilities seeking to procure maybe 100 megawatts of renewables to now looking to procure gigawatts. I think probably among all of Indiana's investor-owned utilities, there's demand, in excess of 5-6 gigawatts, which is 5,000 or 6,000 megawatts for renewable energy. And if we're going to satisfy that demand and capture the economic development benefits associated with it, we're going to have to look very seriously at building these in these rural areas throughout the state. Our projects that Hoosier Solar is developing are in 4 of these opportunity zones in 4 different rural counties. They are Adams County, Rush County, which is in the kind of southeast. Adams is in the northeast, Stark County in the northwest, and Du Bois County in the southwest. So 4 different counties kind of spread across the state. Our selection of those specific locations had a lot to do with not only access to land, but also proximity to major transmission infrastructure connection points. So essentially large substations that can be tapped into to access the wholesale markets. We have across our 4 opportunity zones, we have a total of 6 projects, 3 of which are for the MISO wholesale market system, and 3 would be going into the PJM market system. MISO is more of the mid-continent and Midwest, which is most of Indiana. And then Indiana also has some of the territory that is part of the PJM market, which moves out into the East Coast, Pennsylvania, Washington, D.C. area, Ohio, so on and so forth. So a diversity of markets that our projects would be sold into. If you go to the next slide, the economic development benefits associated with large-scale solar projects are pretty consistent, regardless of whether they're in an opportunity zone or not. So the added benefit of being in an opportunity zone is really twofold. One, there's a benefit to the investors. They get some additional tax incentives to make that investment. But also, obviously, we are locating these investments in communities that are distressed. And so a lot of opportunity zones are in more urban areas where I think we typically think about, distressed communities, distressed neighborhoods. But there are a lot of rural communities across our country, and including the state of Indiana, where there's a lot of economic challenges. There's, family farms that are struggling. There's communities that are struggling to retain their population or attract any new population. And so these projects generate value across the life cycle of the project. First and foremost are the land lease payments that are made to the landowners. So, just one of our project, take the one up in Adams County, we have about 30 landowners that are signed up. That encompasses about 3,000 acres. That project is scoped to be about 340 megawatts of power. So it's a significant footprint with a lot of landowners, and they get long-term lease payments that would last for the life of the project. So typically at least 30 years that they receive those lease payments, and they're in excess of what they would typically receive if they were to continue to just farm that land or lease the land to farmers. You have tax revenue for the counties themselves, which is important, and our commitment is to pay those tax benefits to each of the counties in which we operate. You have the raw materials. We're trying to source as much of that as possible from in-state. You've got local labor. A large project may employ several hundred people for 9 months to 12 months, and can really have a huge kind of stimulus impact on the local community. And then, of course, there's the long-term energy cost benefits. Solar projects today are generating some of the lowest cost energy, and it's energy that we can rely on to stay at those rates, for years to come. Next slide. Just to wrap this up, because I know I want to make sure we leave plenty of time for questions and conversation. ESN, the group I lead, together with Advantage Capital and Innovative Solar, in the summer of 2020, I should have mentioned that, early summer of 2020, formed Hoosier Solar as an Opportunity Zone Fund company. to develop a gigawatt of solar assets across Indiana opportunity zones in 4 different counties, 4 different zones. And our expectation, if we're able to reach this objective over the next couple of years, is that it will result in over $1 billion of capital investment, generating hundreds of millions of dollars in tax revenue over the life of these projects, significant landowner wealth creation, which is important for those communities. A lot of that wealth gets recycled within the communities. We're going to use 100% Indiana-based labor and try to source as many materials as we can from the state. In the long run, we're also doing good for the environment and doing good for Indiana and our country's transition to renewable energy, especially in a state that has historically been very coal dependent. I used to be Governor Mitch Daniels' policy director in the early 2000s. And at that time, I think we were 95% dependent on coal power for our electricity. And, now it's amazing to see the transition and just how dramatic that transition is. It can also be, a negative impact on the economy if we don't do these kinds of things to ensure that these investments in renewable energy actually take place in our state, and we're not becoming a net importer of renewable energy from other jurisdictions.
Thanks so much, Paul. There's been a number of questions that have trickled in during your presentation, so I'm just gonna shoot them off to you. So to take the first question, if I heard correctly, there's sort of 2 key factors that weighed into your decision about where to locate. Number one is availability of land, and then the other is proximity to, I would call it like distribution infrastructure for electricity. So when it comes to the quality of land, could one of these projects be feasible in a floodplain or floodway fringe farmlands?
Yeah, so that's a good question. And the answer is it depends. We're actually kind of in the middle of trying to do that engineering work right now. We found that many of the opportunity zones that were designated in Indiana that are very rural, where there's large tracts of land, are actually in areas where there's some flooding, either 100-year floodplains or in some cases, even wetter than that. That's not surprising, right? Because in order to be designated as an opportunity zone, you have to be more economically distressed. And if all of the farmland in that area is the best, most productive farmland, you're probably not going to be economically distressed. So the short answer is you can. It always is about cost. It costs more money to do the mitigation and to do the engineering and construction to avoid the negatives of wetland. So it can be done. And also, just kind of in a related comment, a number of our landowners are long time, generational family farms, and they're approaching this where they are leasing us some of their land. They are by no means leasing us all of their land, and they're leasing us land that is in areas that are either less productive or fields that are harder to get to. And as a result, we're going to generate revenue for them through long-term lease agreements that make them more economically stable so they can continue to farm their more productive land that may be, fields just across the road or even adjacent to where our developments are going.
Yeah, so highest and best use of that land probably for them.
Mm-hmm.
How, I'm thinking when you said that there's 30 folks that are in line to sign up for this, landowners, did the counties do outreach? Did the state do outreach to kind of develop that pipeline of potential leases for you? Or
no, that's work that we do at Hoosier Solar. So renewable energy developers in America today are not unlike the developers of oil in southern, in Texas and whatnot. You go door to door, you go farmer to farmer, you go and hold events at the local fish fries, and you do just about everything you can. It's also very difficult during the pandemic to do that safely and securely. So no, our counties we met with and gave them a heads up, and we often would get letters of support or let them know we would be talking to landowners. But in most rural communities across the United States, local governments are very hesitant to tell farmers what they should or shouldn't do with their land. And so it's really a landowner by landowner decision. And we had to build relationships with those individuals on a case-by-case basis. And in some cases you figure out pretty quickly in those communities there's certain landowners that carry a lot of weight with their neighbors. And if you can sort of convince them to do it, they may be a majority landowner in the area, then other people tend to come along. But in total, across our four counties, I mean, we have well over 120 different landowners that, are under lease option agreements at this stage. They start as option agreements and then they convert into real transactional leases once you move to the construction phase.
Yeah, that sounds like true on the ground community engagement to me,
Yeah.
Paul. And it also, I just realized that, a lot of I don't want to say critique around opportunity zones, but potentially that is what it is, where folks are saying, but how do residents of opportunity zones benefit from the policy or generate wealth from the policy? But this land lease model that you have, where you're leasing from residents that own land in opportunity zones, that's actually helping them generate wealth or at least income.
Yeah, I mean, these land lease agreements are very good for the landowners. It often can double or triple what they're getting in either for farming the land or for leasing it to farmers. And then the tax revenues for these counties can be really significant. So obviously those benefits get spread broadly across all the folks within those more rural counties. We also have been, making commitments to invest in things like putting solar on the roofs of these rural high schools and doing outreach to the high schools to try to get young kids, I guess they are, that are graduating to think about getting into the solar construction industry. It's a job that they could stay living in these more rural communities and work on not only our projects, but other projects in rural areas throughout the state and even throughout the Midwest. It's a very good job and can pay a good living. So, we're trying to do everything from help these communities with wealth creation, tax revenue generation, and, try to create, pipeline of job opportunities for their young persons.
Yeah, so similar to Julia's project or investment, there's some workforce development, jobs of the future aspects to the broader model or the ecosystem that you guys are creating. There's a question from Brad. It sounds like there may be some restrictions or disruptions around the way that solar panels are sourced right now. I don't know if you're familiar with that. There's more detail in the question, but just a broader question around supply chain for sourcing solar panels. Yeah.
That's a good question. I mean, it's something we're paying close attention to. Our goal is to source as much as we can, if not everything, from US based suppliers. But, as this solar market is global. There are real challenges. Even if you're getting the panels sourced from a US company, there may be materials and things that are in there from overseas. So it is an area that we're looking at. I'm not sure our company necessarily is going to have a lot of influence on that. It's probably going to be some of the bigger players that are doing, we're looking to build a gigawatt, which sounds like an amazing amount of energy. It is, but in the grand scheme of things, there's developers that are building, 50 or 100 gigawatts across the United States. And I think those are the ones that are really going to drive some of the changes in that supply chain, along with US policies.
Yeah. And going back, and maybe that's a good segue, going back up to the top of our discussion around US policies, especially around federal funding or tax incentives. And Julia, this is a question for you too. Are there forthcoming or potential programs or tax policies that both the business could be taking advantage of as well as the investors?
Yes. I mean, there are tax credits for EV charging businesses. Once there's, you've reached certain profitability marks, it makes sense to leverage those or sell them in the secondary market if there is such for those. But it appears that under the Biden's new policies, there'll be even more incentives around subsidizing electrification and municipalities buying fleets, federal fleets. Of course, there's about 600 to 800,000 federal fleet vehicles that have committed to going electric. The time frame is pretty long, but of course, but that's a huge amount of cars. And a lot of municipalities have a lot bigger fleets than we think about that are distributed, like police vehicles. There's public works trucks, parking ticket operators. So there's a lot of different segments that can be driven to go electric by either local policy or federal policy.
Mhm. Yeah, and Paul, what about you? Was this project or up to date fully funded with OZ equity, or was there some additional source of capital?
So it's a mixture. So right now, the funding that is paying for this development work, which is the doing the engineering planning, signing up the land leases, submitting these fairly expensive interconnection license applications to the wholesale markets, is all being done through a capital raise. It was around $20 million of 100% OZ funding just to do the development work on these projects. As you move from development phase to actually signed agreements for offtake and approved interconnection licenses in the wholesale markets, you then go to construction, right? When we go to construction, there'll be a mixture of solar investment tax credit investment capital that will come in, potentially additional opportunity zone capital. At that point, it may be a couple years out. So we want to track closely what happens with OZ rules and whether things are extended and how attractive those benefits will be. And then, additional just equity, tax equity that would be invested. So like any renewable energy project, they're all dependent on these federal tax programs being in place. Even some of the tax incentives on the panels and everything is sort of enhanced at some level. The OZ is just layered on top of those traditional credits, and it determines sort of where we actually physically build these projects.
So it really is influencing your decision making as a business where you go.
Absolutely.
And then Paul, just one quick clarification on something you said earlier. There was a $1 billion number, and one of our attendees is asking. Yeah. Okay.
Yeah. So yeah, I mean, as a general rule of thumb in the solar industry, it's not exactly right, but you often say $1 a watt, right? And if you just do the math, it's about $1 billion for 1,000 megawatts, which is a gigawatt. So that's the total amount of capital that's needed to develop that project from nothing to the fully installed project that's going to be capitalized over 30 years. Not all of that is equity that's needed. Some of that is tax credit, value, and the way that all comes together. It's not like we're going to go out and need to raise 1 billion in opportunity zone funding to execute on $1 billion project. There's a mix of debt and equity in these projects, but the cash cost of building a gigawatt of solar in the United States today is around $1 billion. Some might say it's down to maybe 900 million.
Awesome. Thank you for that clarification and also explanation about, I do not know how watts are priced. So it's
all, and I will tell you that the pricing of how you sell that electricity, which maybe we're more familiar with, most of these solar projects today are signing long-term contracts where they're selling the power for about 3 cents a kilowatt hour, or even 2.8 cents a kilowatt hour. If you think about it, most of us are paying 8-9 cents for our electricity at home. In some states, we're paying a lot more than that. So America and the world has done an amazing job at driving the cost down on these solar projects to make them economic and make them work. There's obviously some tax benefits. There's obviously some government incentives to do that. But a lot of it has just been pulling the cost out of building these projects and just dramatic reduction in the cost of the panels and higher efficiency in those panels.
Yeah, and I think that goes to another Biden administration priority around financial well-being for families, being able to save on their electricity costs. We are right at 3. I want to turn it back over to Emma, but also before I do that, Julia, Paul, any final thoughts? Want to open it up for that?
Well, just to sort of add on what Paul was saying, it's exciting for the more we can generate sustainable solar power and complement that with electrification of the vehicles and actually power the electrification through solar. That's the more exciting and more impactful that we can like merge those benefits and also even stabilize energy grids at locations like solar infrastructure plants where we depend on the sun, but we can also have backup of a battery system and electric vehicles to back that up as well at peak time. So it's all becoming one integrated renewable system, which is very exciting. And it's just the beginning now. So it's kind of an exciting frontier for, I mean, not the beginning of solar, but the beginning of this new world of energy. Let's put it that way.
Couldn't agree more. Very, very well put. I 100% agree.
Thank you.
Like a good investment
The
opportunity.
opportunity for being here and organizing this.
Thank you.
Absolutely. Thanks to you both. Emma, I'm gonna let you take us out.
Thanks so much, Rachel. And thanks to both of our presenters for that really just fascinating conversation about how we can use opportunity zones to invest in clean energy and green infrastructure. So you'll see on the screen that we have everyone's email address and contact information available. Feel free to reach out to any of us if you have additional questions or comments on the webinar or the topic at hand. And thanks everyone for your participation. As I mentioned at the top, we will have all of this information available on our website. And we will also distribute to attendees and registrants shortly after the webinar. So thanks again, everyone, and I hope you have a great rest of your afternoon.